Everybody, thanks for tuning in. Take a look at the market here. My name's Mark, and I'm the stockmarketjobber.com. Please check out our site, stockmarketjobber.com, and be sure to subscribe to our YouTube page here. I have a lot of experience in trading. I was head of trading at 3 different institutional money managers where I oversaw various trading strategies and, yes, hedge funds. I know everyone's so fascinated with hedge funds. I traded directly for 2 of the best fund managers in history, Gabelli and Steve Cohen. I was also a market maker, a master's degree from finance from NYU. What else? How else can I promote myself? Oh, yeah, I've had the CMT for 20 some odd years. But anyway, whatever. I'm not here to talk about me. We're here to talk about why I think the market is kind of going to pause out here for a while. So I know we got a lot of important news this week, but thinking there's a good chance we go lower, and I'll tell you why. So first of all, this is the S&P 500, right? And we can see we got up to this resistance around 410. I should probably push that down a little bit more, but same level as back here and back here. So this is what we call market memory, when we have a level that retains its importance for a long time. But what I want to show you is this. It's important to remember that this is the sum of its parts. Now it says the S&P 500 because there's 500 stocks in it. But each one of those stocks is in a particular sector. There's 11 sectors. And sometimes by looking at the sectors, we can get insight into what the broader market or S&P is going to do. And as we'll see, things are running into resistance and healthcare is breaking support. So that kind of tells me that the path of least resistance is down. I mean, we don't really know what's going to happen. There's no guarantee, but sometimes we let the market speak to us, and the market tells us things by how it reacts when it gets to these certain levels that are important. This is the market here, okay? This is the 11 sectors that make up the S&P 500. As we can see, technology, healthcare, financials, consumer discretionary, these are the biggest. So let's see, 21, 35. So there's about 60% of the market is these 4 sectors. And they're all looking kind of vulnerable. Now, sometimes these sectors down here can have an influence, but not as much just because they're just not as big. But again, 60% of the market. So first thing we're going to look at is technology. And we can see we're trading just below resistance. On Friday and Thursday, we got to this resistance and failed, meaning we didn't get through it. This is around the 137 level. You can see it was resistance back here. So this is our biggest sector in the market at resistance. This is our healthcare sector, which is the second biggest sector in the market, and support seems to be breaking away. You can see here how this level that was resistance converted into support. This happens because of market psychology, believe it or not. People sell here, and a lot of them regret doing so when the price goes higher, so they tell themselves they're going to buy their shares back. So if there's enough of these remorseful sellers placing buy orders at a former resistance level, it converts into support, and that's what happened. But now this support seems to be breaking. This means the sellers are overpowering the buyers. There's more selling or sell orders than there are buy orders, so sellers are forced to push the price down. So we got our biggest sector just under resistance, and resistance is a large group of sellers. We have our second biggest sector seemingly breaking support. So a big part of this is understanding how certain price levels have more importance than others. And we can see here, for whatever reason, XLV likes the 134 level. Down here, the 120 level was support here, support here. Knowing where these levels are is like having a map to the market. It tells you where it's going to turn, right? The levels are like a fork in the road, and when they get to them, they tend to make a move one way or the other. They don't usually hang out at an important level for too long. Our financial sector is also run into resistance around 3650. It's the same level it got to resistance back here. So we have tech stalling out, we have financial stalling out, we have healthcare, looks like it could be breaking down. I like that like that effect. And here we have our consumer discretionary sector. And as we can see, it is also at resistance. So like I said, 60% of the market looks kind of vulnerable, meaning it's either at resistance or like healthcare, the support is breaking down. So consumer discretionary, technology, and financials are all hitting resistance. Resistance is a large group of sellers. When a market is moving higher, it's because there's not enough supply or sellers to fill all the demands or buy orders, and the buyers are forced to offer to pay a premium, and that forces an uptrend. When we get up to a resistance level, well, the tide turns. There's more than enough supply to satisfy all that demand, and a lot of times markets stall out or rallies stall out, and they reverse when they get to resistance, like they did back here. So that's what I'm keeping an eye on for the rest of the week here. It's a big week. We got some big earnings. So please check back with us here at stockmarketjobber.com. Join our community. Please subscribe to our YouTube page here, and I hope to talk to you soon. Thank you, everybody.